Welcome to this explainer. Today, we are diving right into what is absolutely one of the most fascinating macroeconomic mysteries of our time, Japan's eternal insolvency. I mean, it's a story that challenges literally almost every assumption we have about government borrowing. Seriously, it's basically one of the most incredible financial experiments in modern history, and we're going to break it all down. So to kick things off, let's just imagine your own personal finances for a second. Picture yourself owing more than twice your entire annual income, right? For the vast majority of us, that kind of crushing financial burden would spell immediate disaster. The math just wouldn't work out, and you'd likely be heading straight for bankruptcy. Well, now imagine an entire country doing the exact same thing. Japan is carrying one of the highest government debt levels in human history. We're talking about a national debt that is literally more than double the size of its entire economy, over 200%. By any normal economic standard, this sounds like an absolute train wreck waiting to happen. And yet, the economy hasn't collapsed. The system still works, the currency is stable, and everyday life just keeps on going as normal. So, what on earth is Japan doing differently from the rest of the world? Let's figure it out. Let's get into Section 1, Decoding the Debt. How did we get here? Okay, so to solve this mystery, we first need to quickly break down the basic mechanics of government finance. Step 1. A government spends more money than it actually collects through taxes. Step 2. To cover that gap, the government has to borrow money. And Step 3. To raise those funds, it issues government bonds to investors. It's a totally standard practice globally, but the sheer scale of how Japan uses this loop, that's what really sets it apart. See, Japan has been running the cycle on repeat for decades. They've been pouring massive, eye-watering amounts of money into a few core domestic areas: healthcare, national pensions, giant infrastructure projects, and wave after wave of economic stimulus programs. Because of all this relentless spending, the debt just kept growing and growing into a historic mountain. A lot of economists looked at this and braced for a massive crash. But, well, that crash never showed up. Moving on to our next part, clue number 1, the ownership secret. Now, take a look at the massive slice on this chart. This is huge. The vast majority of Japanese government bonds are actually held domestically. We're talking about Japanese banks, Japanese pension funds, local insurance companies, and the country's own central bank holding almost all the paper. So, in very simple terms, Japan essentially owes this massive pile of money to itself. And guys, this domestic ownership structure is a total game changer. Think about it. In a lot of other countries, a huge chunk of government debt is held by foreign investors. That's super risky because if those foreign investors get spooked, they can panic, sell their bonds, and pull their money out overnight, creating instant chaos. But Japan? Because its debt is owned at home, there's this incredible built-in layer of internal trust. It totally insulates them from the kind of sudden capital flight that usually triggers a crisis. Which brings us to clue number 2, the power of low rates. Let's take a look. Now, interest rates dictate how expensive it is for a government to borrow money, and for years, Japan has kept rates extremely low, sometimes literally near zero. Imagine taking out a gigantic, multi-million-dollar personal loan but paying absolutely nothing in interest. You could carry that debt forever, right? Well, that is essentially the situation the Japanese government has engineered. They can borrow mountains of cash without facing the massive interest payments that would normally crush a national budget. But you're probably wondering, why is the money so cheap in the first place? To get that, we have to travel back to the early 1990s. Japan had this massive asset bubble that eventually popped. Property and stock prices completely collapsed, and the economy entered a painfully long period of stagnation. So to fight this, the Bank of Japan stepped in and slashed rates to the floor to encourage people to spend and invest. And honestly, over time, those rock-bottom rates just became a permanent fixture of their economy. Actually, the Bank of Japan didn't just stop at lowering rates. They took it a step further. They play a really unusual role by actively stepping in and buying up massive quantities of these bonds themselves. By gobbling up a huge portion of the nation's debt, the central bank is heavily manipulating the market to keep the whole machine running smoothly. It basically gives the government ultimate flexibility to manage its finances. But it's not all smooth sailing. Let's look at Section 4, the ticking clock, future risks. So the biggest threat to this whole balancing act comes from a massive demographic shift. Japan has one of the oldest populations in the world. People are living longer, and at the exact same time, birth rates are dropping. Get this, adult diapers now famously outsell baby diapers in Japan. It's wild, but it creates this terrifying scissors effect. The government is facing skyrocketing costs for elder care and pensions, exactly while the younger tax-paying workforce is shrinking. That puts immense pressure on public finances. On top of that, there's the big elephant in the room. What happens if interest rates actually rise? Japan has been riding the wave of near-zero borrowing costs for decades, but critics rightly point out that this can't last forever. If global or domestic pressures suddenly force those rates to spike, servicing a 200% debt mountain could literally break the budget overnight. The interest payments alone would be absolutely crushing. All right, let's wrap this up with Section 5, the verdict, redefining economic rules. The real takeaway here is that the raw size of a country's debt doesn't just automatically trigger bankruptcy. It's all about the structure. Who owns the debt? That's absolutely crucial. What are the interest rates? How stable is the baseline economy? And most importantly, do domestic investors have confidence? Japan has super strong institutions, and it borrows from its own citizens. And that, my friends, is the secret formula keeping them afloat. So as we finish up this explainer, we're definitely left at a fascinating crossroads. Japan's story throws almost everything we thought we knew about government borrowing completely out the window. It really makes us wonder, can this incredibly tight high-wire act of low rates and domestic trust actually last forever against an aging population? Will this unique financial experiment eventually crack? Or has Japan literally just written a completely new rulebook for global economics? It's a massive question, and you can bet the whole world will be watching. Thanks so much for joining me on this deep dive.